strong.
So let's talk about fixed and variable rates and which one you should go with. It's going to depend on your individual circumstances and on what you want to do as far as paying this loan off faster as to which one you generally go with. Now, a fixed rate, you have the certainty of knowing that that interest rate won't change for that length of time that you're fixed for, whether that's 1 year, 2 years, 3 years, up to 5 years ideally. Now, that means that your mortgage repayment won't change, but if rates do drop, your rate doesn't. It stays up at where it was when you fixed it in. It also has the benefit, however, that if interest rates do rise, then yours will still stay where it is and your repayment is certain. Now, on a fixed rate, you can make extra payments as well to a limit. So most lenders will give you either a $5,000 or $10,000 amount that you can pay per annum, or perhaps $30,000 over the term. It just depends on the lender you're with. Now, on a variable rate, you can pay as much as you like off without limit. Okay, it's much more flexible. The interest rate does go up and down as interest rates rise and lower, but you have got that flexibility. Now, with the next part there on redraw, with a fixed rate, the extra money you do pay off, you can redraw, but not until you come off the fixed rate. So you have to wait until your fixed rate term is finished, whether that's 2 or 3 years, and then you can do your redraw. On variable, when you pay extra off over and above your minimum payment the same, you can redraw that at any point. Some lenders have a minimum of 500 or 1,000, and it just comes down to which lender you choose. Now, one last thing is rate lock. Now, this applies just to a fixed rate product. Now, when you apply for your loan, say for example, the interest rate is 2.5% on the day you apply, but by the time your loan settles, which could be 4 to 6 weeks later, the interest rate may have either gone up or down. So you get whatever the rate is on the day of settlement on a fixed rate, unless you pay an extra fee, which is called a rate lock fee, which the lender will give you the opportunity to do, but it will cost you the money to do it. So what that fee is depends on which lender you're with and how much you're borrowing. So in summary, the fixed rate gives you certainty, so you know what you're paying and you won't end up with any surprises. However, there are penalties if you pay that off sooner. So, for example, if you were to sell your property or refinance your home loan whilst you're on a fixed rate, there's quite often break costs associated. With the variable rate, you've got flexibility to do as many payments over and above your minimum as you like, redraw that back when you need to, and that's that.
Okay.